Now with more is Michael Lee. He's the founder of Michael Lee Strategy. Michael, good to see you this morning down there in Orlando, Florida. Stocks certainly trying for gains. What do you think this market is going to do?
Yeah, look, I think, short-term choppiness is likely to continue, but on a trend upwards. Valuations are somewhat elevated, but I tend to think this market is going to go much, much higher. In fact, I don't know that I've been more bullish in my entire career than I am now, because you need to look at where we are from an earnings standpoint. So expectations, in my opinion, are too low this quarter. We're likely to exceed the quarterly estimates of roughly 8% growth. I think we come in like last quarter, in double-digit earnings growth year over year on the whole as a market. We just got massive fiscal stimulus in the form of the big, beautiful bill. And then it looks like monetary policy is really about to kick in with, inside of a year. I think short-term rates could be as low as 2.5%, if not 2.75%. And Paul Tudor Jones shares that view with me. And then on top of that, you have large deregulation as well as artificial intelligence, just really driving the entire technology story behind it.
I'm interested to hear more about your bull thesis here, Michael, because you referenced Paul Tudor Jones. He did say that the stock market has more room to run, but then he does expect a bit of a dramatic pullback. Are you on the same page as that, or do you think this is a lasting run ahead of us?
Yeah, I think we have years to go. And Goldman put out a great research report talking about the investment in AI relative to other trends in history. And we're nowhere near close to the money they put into railroads or a few other kind of these turning point in history, massive investments. And so I think we have many more years to go. And I would absolutely love to see this blow off the top rally. I just don't think we're anywhere near that yet. And so you look at a forward PE of the S&P 500 and you're in the low 20s. Well, if earnings come in 10 to 15 or 20% higher than expectations, you're really in the high teens, which is certainly by no means cheap. But then you look at this macroeconomic backdrop and what's going on with artificial intelligence on top of it. It's not, yes, I'd like the market to be cheaper to buy stocks. It's just not the world we live in. And I tend to think things that are expensive tend to get far more expensive. And you have so many people talking about a bubble, talking about lofty valuations. You almost by default don't have the exuberance needed for that blow off the top rally or for this quote unquote bubble to burst. So once everyone starts telling me it's going to go on forever, that's when I'm going to start selling. But now when people are telling me it's overvalued, I think we've got a lot of room to run.
Interesting. Okay, so I do want to drill in a bit on interest rates. You anticipate them to come down. Of course, the Fed is set to meet at the end of the month, and the market is pricing in a 0.25 percentage point rate cut. But now in week 3 of this government shutdown, we have been without some key economic data, including the latest non-farm payrolls report. How does that factor into what we hear from the Fed at the end of the month?
Yeah, look, I don't think it does. And I think, the massive, something is broken at the BLS, right? And I think their data collection methods or their methodology, it hasn't worked well since the shutdown or since COVID, right? When you had all those people leave their jobs and then come back into the workforce, it doesn't seem to me that they've been able to accurately or with any reasonable amount of tracking error, measure the jobs data. So you can still see a lot of the weekly claims that hasn't moved much. The continuing claims hasn't moved around that much. And maybe, I think it's a little bit outlandish to believe that Jerome Powell was blindsided by the million job revision in 2024 or the 800,000 job negative revision in 2025. This has been a constant where these job numbers come out only for massive revisions, almost always lower by the final revision. So I'd say in normal times, if we were to rewind the clock 5 or 6 years ago, that would be a big deal in Fed policy. Now, I can't imagine it has to be one just because of the inaccuracy of the data, if that makes sense.
All right. Michael Lee joining us from Orlando, Florida this morning. He's the founder of Michael Lee Strategy. Michael, good to see you.
Thank you very much.
Thanks.